Well, as we just noted a few moments ago, North American stock markets are barreling into the last month of the year at record highs. Our next guest says he remains bullish on stocks. He believes the drivers of this bull market remain intact. Let's kick off our programming for you this morning by welcoming Ed Clissold to the show. He's Chief U.S. Strategy at Ned Davis Research, and as you can see, he joins us right now. Ed, thanks a lot for joining us. What are the drivers of the bull market that you see in place at this point?
Yeah, the three main drivers are, first of all, disinflation. Inflation has been falling since September of 2022, and it continues to do so. And now we have a fairly friendly Fed to back that up. Secondly, we have earnings acceleration, or quarter over quarter. Earnings growth is faster than it was the previous quarter, and that's continuing through, it looks like it's going to be through all of 2024. And the third driver is the technicals. Despite all the consternation over the Mag 7 dominating the cap-weighted indice returns, actually most stocks have been rallying, and that's what you like to see. You want to see most stocks participating in a rally. So as long as those three pillars remain in place, we'll remain bullish.
You do say, though, in some recent commentary that you have concerns about each of those drivers as 2025 advances. Do you see some strains on the bull market midway through 2025?
We do, and I want to first, before I get into those, I want to stress that, look, there's concerns that come up all the time, and most of them don't come to fruition. So that's why we're staying bullish rather than getting bearish now and thinking that something might happen. But what those concerns are first and foremost that inflation may stop declining. When we get to the second half of next year, we could have some policy constraints with tariffs, but what seems to be more likely to happen is that the owner's equivalent rent, kind of the housing portion of a lot of the inflation indices in the U.S., are going to likely start to rise some more. And so that's going to make it more difficult for inflation to keep falling. So we wonder how long the Fed's going to be able to keep cutting rates. The second thing is that it's likely that the biggest stocks in the U.S. are going to be suffering from the law of large numbers when it comes to earnings growth. It's just very difficult to sustain the kind of phenomenal growth rate these companies have put up over the past 6 to 8 quarters. And so it's going to be incumbent on the rest of the market to make up the difference, and that may be kind of tough. So we could have modest earnings deceleration in 2025. And then when that happens, you have to ask yourself, well, are the technicals going to hold up? We've already seen a little bit of that since the election. I'd call it more of a rotation rather than a truly broad rally. And so again, these things kind of come and go. Most of the time they resolve themselves to the upside. But there's a potential here that what the rally did is the election did is it's going to start pushing people into the same stocks, and then we get a narrow rally. And when those stocks inevitably run into trouble, then there's not a whole lot for the market to stand on. And so those are our concerns going into next year. We'll see if they come to fruition.
You've recently upgraded consumer discretionaries. Why so, given the what kind of assumptions are you making about the state of the U.S. consumer and the U.S. economy when you upgrade consumer discretionaries?
Yeah, well, first of all, from a technical perspective, the sector looks good on an equal weighted basis. The index continues to do very well, so it's not just the mega caps. So that's one thing. And the second thing is, it's hard to bet against the U.S. consumer, especially on the prospect of the Trump tax cuts likely being extended, a potential for some additional things like the SALT tax, which expired for state and local taxes in some of the high tax states. That may come back, which will give some more money in consumers' pockets. So I think, at least for now, the sentiment towards the discretionary sector is pretty positive. And we saw that, with some decent numbers for the Thanksgiving weekend holiday spending. So the consumer feels pretty good at the moment.
And you've also upgraded the U.S. financials, which, of course, took off on November the 6th, the morning after the U.S. election.
A lot of that is on regulatory expectations. There'll be more M&A activity with less less oversight, and also in general, the financial sector may not have quite the heavy hand that it had under the Biden administration. We also have been expecting the yield curve to steepen. That's kind of stopped. So that's one thing we're keeping an eye on, that if the yield curve continues to flatten or invert, that may be problematic, particularly for some of the regional banks that are so dependent upon that spread between short-term and long-term interest rates. So we still like the sector, but that's something we're keeping an eye on.
Okay, let's finish with your view on the U.S. healthcare sector. There you've actually downgraded that sector.
We have, and a lot of that has to do with concerns around the election. It's very common after a change in party leadership for several months for the healthcare sector to underperform, because it seems to be a popular punching bag for a challenger to say, I'm going to fix healthcare. That seems to be the case this time, and we'll see if it works. A lot of times it doesn't. In 1992, Clinton came in with a big plan to reform healthcare. It didn't happen, and so we'll see how it goes in 2025. But for now, it seems like a sector you want to avoid. And in general, we like cyclical sectors over defensive sectors. So it's kind of going against the macro headwinds as well.